We're going to start off with grains and oilseeds. So let me introduce another colleague of mine, our Deputy Chief Economist, Des Sobel. How are you, Des?
Good. How are you, JP?
I'm super well, thanks. And so let's talk about grains and oilseeds. I mean, in all the outlooks that we publish, we spend a great deal talking about the balance between supply and demand. I think it's always like, or we always like to summarize some of the pricing trends through a statistics that we call the stock to use ratio. So what can you tell us about, globally, how are stocks, thinking of supply and demand trends, and what do
Yeah,
you expect in 2026?
no, it's a great question, and thanks for everybody for joining us today. We look traditionally at supply and demand that determine commodity prices, and as you alluded to earlier, JP, these geopolitical risks that we're seeing, trade disruption, tariffs, are distorting the markets, and it's actually diminishing the significance of some of these traditional market fundamentals. But I don't want to discount it, so I want to focus on where we are from that supply use standpoint. When we look globally for most grains and oilseeds, excellent production this year, optimal growing conditions. We're seeing very strong supplies around the globe. You look at the US, they both had record corn yield and near record harvested area. So strong corn production, as well for soybeans, record yields. And so we're seeing really strong production south of the border as well. And while markets right now have been focusing on what's going on with the US and China, specifically exports of soybeans. And so we've seen that, there was a trade agreement signed. So there actually have been some soybeans moving now, or some fulfillment of contracts. I think the most recent announcement is they've reached their 12 million ton commitment target with US. This is still a long ways off from the 25 million target that they have set for the upcoming years. So that'll be something to watch really with the US and China as these dynamics, because that does influence demand for US soybeans, which does impact prices and does flow over into Canadian prices as well, specifically for canola. As well, we need to look at South America. So they are having their crop will be harvested soon. And then we've seen South America, particularly Brazil, starting to capture a lot more of that global export demand. So overall, good weather in Brazil. We're seeing actually increased acreage as well. So Brazil is becoming one of those main players in the export market. So that's pushing production up and prices down. So we'll be watching that as well. And the one thing to note is Brazil is actually getting more of the Chinese market. And so if we look back to 2019, China and the US had a trade dispute then over soybeans. So China went to Brazil and started sourcing from Brazil. And when that agreement between the US and China was resolved, China didn't go all the way back to the US market. They stayed with Brazil. And so we're seeing that dominance with Brazil going forward as well. And as you can see on the screen, when we take this together, this is the stocks to use ratio. So this is basically looking at what is the supply globally and what is the demand. And we can see for corn, it's been fairly flat. So even with that increased production, there's been only a slight uptick in the stock to use ratio, which means really strong demand still existing for corn. For soybeans, even despite that increase in the production, demand is increasing at a faster rate. So we're actually seeing that stocks to use ratio come down, which is continuing to keep the support prices somewhat. However, when you look at wheat, again, production's up, but demand isn't keeping pace. So we're seeing an increasing stocks use for wheat. So that's going to weigh on prices as well.
Um, the one thing, I mean, that I find interesting is wheat way up. I mean, significantly up. Soybeans slightly down. Corn's kind of moving up a little bit, and then the U.S. production kind of. The stat that I really like was that production in the U.S. from 2024 to 2025. So that production that we're going to market in this current marketing year out of the U.S. That increase in production in the U.S. is 4 times, more than I think, almost 4 times to be accurate, almost 4 times the total production out of Canada when it comes to corn. So it's just like we're just talking about the increase from year to year being equal to 4 times production in the country here. So, well, let's talk about production here in Canada, I guess, is what can we say about how we've done, trying again to think of, right, this is the picture globally that we have in front of us, but if we abstract now from this, think of the domestic market, what can we say?
So last year was fantastic. Canada reached a record 107 million tons of grain and oilseeds being harvested. So that beat the prior record in 2020 by about 7 million tons, and it's 16% higher than the 5-year average. So that's something that's really good news. And When you look across the country, though, there was some variability. If we look in the west across the prairies, we had timely precipitation. We had really optimal growing conditions, so we actually saw record yields. However, when you look to the east, Ontario, there was some challenges there with drier conditions. So their production actually fell about just over 3% year over year. The further east you go, the worse it got. So Quebec and Atlantic Canada faced some much more severe drought-like conditions. And in Quebec, production was down 16%. In Atlantic Canada, was down about 18%. So it's very mixed across the country. West, really strong production, and the east, due to those dry conditions, there was some struggles for production last year. It's worth mentioning, so I think this is really important. When you look at some of the major crops, canola, lentils, and across all wheat varieties, production hit all-time highs. So when you look at it at an aggregate, overall, really good news on the production front, which really helped to support revenues in farm cash receipts in the ag sector.
It's hard, Des, impossible to ignore what has happened recently with regards to the trade relationship between Canada and China. Good news. I mean, well, we'll talk about canola for sure. I mean, there are different commodities as well that are not necessarily seeing the immediate benefit, but what can you tell us about grains and oilseeds, the Canada-China warmer relationships that are emerging right now?
I would say the signing of the trade agreement was a huge sigh of relief for the canola sector. And so we saw those punishing tariffs from 76% for canola seed. There's still a tariff in place. It's reduced down to 15%. But that's good news because that provides some certainty for the market and for producers on the upcoming planting season. As well, China eliminated the 100% tariff on canola meal. And so this is good news for the crushers, canola crushers in Canada, because what was happening is there was really no alternative market to China. So they were having to face some pretty significant price declines for canola meal. So overall, that trade agreement, it provides that certainty. So it's very timely heading into the planting season. So, producers can make those decisions on, what crops they want to plant. They have some certainty that there will be market access for canola this year. That's a good news story. I think the one thing to keep in mind as a part of that trade agreement, it's effective March 1st. It's only a 10-month agreement. So it's only through to the end of the calendar year. So that's still a little bit of that cloud weighing over the sector. So this is really why it's critical for the sector and for the government to continue these trade talks and negotiations with China and looking at alternative markets as well. Diversification is key for Canada as we're such an export dominant nation and we want to reduce our exposure to the US. So that's one thing we have to look at for sure is these other opportunities to find export markets. So as well with this trade agreement, the other good news part of it is that it helps to offset some of the announcements coming out of the US related to their biofuel policy and potential changes. So that those changes are still being proposed, but it does look like it could have a negative impact on Canadian canola for sure. So that's good news that we open up the market access to China because there's still some of this uncertainty with US biofuel policy as well. And so when we talk about canola stocks, as you can see on the screen coming up here, there's a chart that shows how important the US market is and where our stocks to use ratio actually is in 2025-26 crop year. We saw a dramatic increase year over year. And like I said, this was due to record production. And you can see this did weigh on prices somewhat. But this was before the market reopened. And so I think that's what we really want to focus on is if the Chinese market, if we didn't regain access, we would likely see, even with average production, canola stocks to use increasing in Canada could have increased this year, which would have pushed those prices lower. So that's something to keep in mind is that reopening of the market is critical because regardless of whatever the price was, there really was no market for Canadian producers to move their canola. So they were going to have to sit on the canola, store it, pay additional cost, lost cash flow because the market didn't exist. And as well, we look at Canadian canola crushing capacity. So there's another plant coming on this year. So that's going to be able to absorb some more of the canola production within Canada. It's really important to highlight our domestic crushing, our domestic value add, because investing in those types of operations or adding that to the sector also opens up diversification opportunities as well. So it allows us to diversify to other markets than the US. To put it in perspective, the new plant coming online this year, I think total crush capacity in Canada is going to be about 15 million tons for canola. which is about 70% of the record production. So it just highlights how that canola crush is expanding and how important that is to the Canadian canola sector. And I do also want to talk about some other crops. So in the stocks to use, I did show wheat. Again, strong production in Canada. Demand hasn't been keeping pace globally, so we are seeing that increase in stocks to use for wheat. But despite that, what we're seeing in Canada is actually still strong demand. So our exports are still really strong. So I think that just highlights, Canada's wheat and how the global market it's desired for its quality, and safety as well. So we're seeing that, but it's still not going to potentially offset all of the increased stocks globally, which will still put some pressure on prices. And we might see some of that wheat being fed into the livestock sector as well. And then switching to pulses, this is one area which really has seen some dramatic price declines over the last year and a half. Probably, for lentils, I think it's up to a 50% price drop. Things aren't looking very optimistic as well because India still has import tariffs on pulses. So that's going to weigh on the prices this year as well. So prices where they're at might come down a little bit further just because of the lack of market access and the tariffs are being put on by India. The good news, though, is getting back to China, is that trade agreement we signed with China allows the removal of tariffs on peas. So it's a bit offsetting, but I think overall there's still some challenges in the pulse sector.
Yeah. The one thing that hit me this morning when I was looking at some charts preparing for this is looking at prices of the nearby future contract relative to the 5-year averages, and for all the crops, I mean, for all the crops, you're looking at a price currently or near-term contract being lower than the 5-year, certainly lower than the 5-year average, and I would say even in some cases lower than the 5-year low, or the low of the previous 5 years. And so when I think of profitability, let's talk briefly about costs, and then we'll put it together, pricing and costs, and what does that look like for profitability?
Yeah, so the cost side, we're still seeing elevated costs. Our forecast is, overall farm expenses this year are going to rise about 4%, and even into next year. So it's not a good news story. We're going to still see that, farm expenses going up. And so I think we've said this numerous times. Each year we've done the outlook is this year is going to be probably the most expensive crop ever put in the ground. And so just to put in comparison, so I was looking up inflation, price increases over time. If you look back to 2019 is kind of our base year pre-pandemic. Overall farm expenses are up over 50% since 2019. In comparison, inflation in Canada overall is up 20%. So you can just see how much more significant the impact of inflation has been on farm expenses. And so, yeah, like you said, JP, when you factor in commodity prices that are softening near the 5-year lows, where input costs are right now, what you can see on the screen now is our estimation of crop margins. And so this is a representative farm. So just keep in mind that every operation will be a little bit different on their scale and efficiency. But what you really want to focus on is the levels and trends. And so on the figure on the left is a canola wheat rotation representative of Western Canada. You can see last crop here, there was a loss. This year, we're saying there's going to be a pretty thin margin this year. And this is before land costs. And this margin, what we're showing for this year, is really being driven by that record production that we saw. So it's not because of strong prices. It's just we had a really, really strong production, which was driving those margins. For next year, average production, where commodity prices are trending, we could see margins dip into the negative territory next year. So not a very good optimistic outlook. In Eastern Canada, it's a corn soybean rotation. Again, it's trended lower this year. Like I had mentioned, production was down across most of the provinces in Eastern Canada. And so next year, our forecast is a slight increase because we're assuming a return to normal production or average yields next year. But whether you look east or west, well below that 5-year average. So margins are definitely are tighter. And so this is where we need to, for operations, for individual producers, what can you control? And so this is really focusing on producers finding those cost efficiencies and focusing on productivity gains. Is that something that they can have within their control that can help improve margins? Even the slightest little bit would help.
And even thinking of the margins and a little bit of upside for next year, certainly in central Canada and eastern Canada when it comes to corn and soybean. I mean, not even accounting for land costs. If you just build in, like, let's say, a rental rate equal to 2-3% of overall value of land, that gets you close to really break even. So, tight year for grains and oilseeds would be the message. There's a little bit like maybe some of the models that we have did not fully capture the upside. Let's say with implementation of China agreement. That would be one thing to consider. We'll see the export pace because that is going to determine at what pace the world market can absorb these larger volumes, right? Just not coming out simply out of Canada, but also of other producing countries. And so that's going to keep an eye. That's what we're going to have to keep an eye on throughout the year.